Hi, in this video I will try to explain this liquidity budget using the change in financial position model, or we also call it indirect method. It seems to be difficult to really understand why do we start with profit before depreciation and then a lot of corrections. I will try to show it in another way and have a look here. Here you can see that the profit for the year was 595. If you look here at the income statement, there is a 595 profit for the year. Somehow it should increase our profit in the budget year because we are selling a lot of things, we are using a lot of products, we are paying a lot of costs and a lot of other things here, and we end up with this profit of 595. So somehow, why don't we start? And sometimes people do that in other books. They start with the profit of the year, 595. But this 595, it is after depreciation. We have deducted 350 because it is somehow a cost, but it is not cash, because the depreciation is a decrease in value of assets that we purchased maybe years ago. So therefore the 350 is not a payment. Therefore this 595 is not our cash profit. We have to add the 350 because they have been deducted. So if we add the 350 here, we end up with an effect of our profit of 595 plus 350. That is 955. So therefore, we could say here, we could start with our profit, and then we could add our depreciation, and then we start our liquidity budget here with this 945. And then there are some different things that will affect our liquidity during the year, which is not part of the cash flow. Sorry, part of the profit income statement. And it is change in working capital. Maybe our trade receivables changed, maybe we purchased some more stock, and maybe we didn't pay or paid our creditors. It is of course not part of the 945. So we have to make a correction for these three things. In this case, it was a minus and a plus and a plus. So altogether, we have these three together. We call them working capital. It is an increase of 1604. And if we go back and have a look here, we can see that the main reason is that trade receivables decreased. It is a plus for our liquidity because some of our customers paid during the year more than we expected, you could say, therefore 1421. So therefore, this is a plus for our liquidity. We added to the profit from the income statement. Then, of course, if we are buying machinery or other fixed assets, we have to deduct it because it is not a part of our income statement. It is things that we are purchasing during the year, and therefore we have to subtract this amount. In this case, we took a loan of 200. So of course, if we are repaying loans or taking new loans, we have to make a correction for this. So we had a loan of 200. That is a plus for our liquidity. And then we paid some of the profit from last year to our shareholders. So we also have to make a correction for this one. Therefore, we end up with a total liquidity of 1859. So we had a profit in our income statement of 595, but because of all these corrections to the liquidity, we end up with a liquidity effect during the year much higher than the profit of 595. We end up with a plus of 1859. This way of doing the liquidity budget was in fact maybe more easy to understand. Start with the profit for the year and then end up after all these corrections. We are doing it slightly different, as you can see here. We are starting with the profit before depreciation, and then we have a lot of these corrections. But because we do this, we still haven't deducted interest cost and tax paid. So if we are taking the 1485 and deduct interest cost and tax paid, then we have the 945. But it consists of these three amounts, and then you can see 945. It is exactly the same as we have here. So we are doing the same, just in another way, and we are showing each of the different working capital amounts, not in one amount, but all three of them. And then we have, as I showed you before, the investments, new loans, and the dividend paid. And then we end up exactly with 1859.